All right, so I'm going to go ahead and get started because it is 5 o'clock, and we do want to actually get moving here. Due to some circumstances, one of our speakers does have to make a quick departure, so I want to make sure we give everybody opportune time to speak. As you know, my name is Aaron Lehman. I am the Chief Investment Officer here at Signature Financial Planning. So for better or worse, it's my job to deal with the market, and the market has been a lot to deal with lately, which is why we're having this call. We're joined today by two very talented economists from two of our very best partners, Fidelity and T. Rowe Price. We have Brad Pineau, who is joining us to talk about the equity market, and we have Franco, who is joining us to talk about the bond market. I'm going to get to intros on them in a moment, but real quick off the top, there are two very important announcements I wanted to make. First of all, I want to make sure everybody knows this call is being recorded. So if you have to leave early, you got to sneak out, or if you just enjoy it so much, you want to keep watching it over and over, we will make it available on the website. You will be able to download it. But I also want to remind everybody this call is being recorded. So please keep yourselves on mute. And if you want to have your camera on, we love it. We love seeing everybody, but just know we're being recorded. The other thing I want to say is questions. If you have questions about anything you hear here tonight, or if you've had questions on your mind that you want to ask, please go ahead, feel free to type them in the chat. The best thing you can do is send them directly to either Mark Tannenbaum or Julia Cresta in the chat. That'll make sure they get added to the list and asked at the end. So chat your questions, whatever you want to ask. If you've been saving stuff up, or if you hear something you're curious about, go ahead and put those to either Mark or Julia Cresta in the chat. All right. So without further ado, then I am actually going to turn it over to Brad Pineau from Fidelity. I have his bio here. I would read it for you. I can assure you it is long and distinguished. All you really need to know is he's a smart dude with some good insights on the equity market. So take it away, Brad. Thank you.
All right, you bet. Well, thanks a lot, Aaron. As I said, good to be with you and good to be with a bunch of everyone else here. And, happy post-Memorial Day. It was a beautiful weekend up here in the Commonwealth of Massachusetts. So I certainly hope it was nice wherever we have been. With that being said, I certainly have the distinguished opportunity to share with you Fidelity's thoughts, right, as we reflect on the first, how to believe, but almost the month of June, right, year-to-date performance of the stock market. And to say it's been volatile, to Aaron's point, would be, I'd say, a bit short-sighted and certainly an understatement. And there's no shortage of factors, right, that have really been driving the market throughout 2022. And if I just think in no particular order, you certainly have this inflation topic, right? 40 years in the making, 40 years in the making. Now monetary policy, right? Interest rates are certainly creeping up to help deal with higher inflation. We know that there's a war going on, and arguably in any other given year, the Russia-Ukraine conflict, even if it was by itself, would have been enough to rattle these markets, but that's just one of other factors. We know that China has virtually shut their cities, right, due to the zero COVID initiative that they continue to employ, although it looks like they might be opening up Shanghai here on Wednesday. We shall see. I guess we'll all wait together to watch. So as I just think about this, as I'm actually saying this out loud, and I do this all day long, it really is amazing how volatile the markets have been, but certainly I don't think anybody would be too surprised. I start with this illustration, though, in front of you, because to me, this is the value proposition that we as investors, and certainly make no bones about it, we at Fidelity are investors as well, but it's really important for us to be reminded of this value proposition of what we should expect to receive as an equity investor and what we should actually expect to tolerate. Now, let me use my pointer here just to accentuate some of these points. 8% annual return is what the S&P 500 has given investors for really 100-year period, right? Some years you get a lot more, other years you have negative returns, but this is the average, right? 8%. And as we think about the tolerate side, right, this is where risk comes into play. What I mean by that is you can't get that 8% return without taking on some downside risk. And you can see what this looks like here, right? 3 corrections of 5% a year, a bigger correction of 10% a year, and even bigger correction of 15% once every 3 years. And then you get this big doozy, right? More than 20% every 6 years. And let me cut to the chase, right? Fidelity is constructive on the outlook for equities, but we're also very much aware that downside volatility could get worse, right? I can't predict if the market has found its bottom. And it's also really important to note that over the past 6 trading sessions, right, over really the past week or so, the market has done really well, right, about a 9% gain in just the past week. So, again, we have downside volatility and we also have upside volatility, but this is the one I feel like investors are wondering about, right? They're either asking themselves, maybe they're asking Aaron and team, right, can the market go down by more than 20%? Now, the good news for all of us, myself included, is that the cadence of this downside, right, the bigger one, the bear market, as they call it, it comes once every 6 years. And it's almost always associated, but not always, with the recession. So we at Fidelity do have, I'd say, a constructive outlook on the economy. But as I say this, think about this. How many times have you heard this word recession on the nightly news, right? I got to tell you, I don't watch the news, but people tell me it's loud and proud and it's a bit omnipresent, right? The expectations that the economy is going to slow down to a grinding halt. Now, lots of interesting colors here. The basics that I'm showing you is that investor sentiment against this value proposition has almost never been this low. And I'm going back to 1988 here. And you can see, right, this is where we're currently at, this first percentile. What this basically tells me is that investors, everyday investors, all of you on the line, right, 99% of the time in the last 34 years have felt better about investing than you do now. There's a lot of compass points here that I look at. This to me is a fairly significant one. So you either will observe this and react by saying, oh boy, this isn't so good. See, I knew it was bad, right? People have never been this bearish. But to me, as a contrarian, and just doing this for 25 years, I actually look at this as being an opportunity, right? This is probably the most positive illustration that I could show you, is that people think it's so bad. And eventually, when people realize, investors realize that, you know what, maybe it's not all that bad, right? Maybe it's better than I feel. Then you typically see good things happen. And who knows, maybe this past week or so is the start of something new. Now, talking about the probability for recession, we here at Fidelity believe it's actually quite low. You can see this green bubble. This is indicative of the US economy. A couple of facts here. We believe that the economy continues to expand, yet at a decelerating rate. That's important to note, right? This is what we call our economic business cycle illustration. I don't want to take you back to economics class, but for those of you who've had this type of observation in the past, what you'll notice is that there are 4 distinct phases to an economic cycle, right? And it really circumvents. And to keep it simple, the first 3 phases, early, mid, and late, these are all pro-growth. They're just at a different rate of growth. Early cycle, you come out of a recession, the economy tends to blossom. Think of it as like a spring up here in the Northeast. After a real cold winter, or even in Pennsylvania for that matter, right? The Western part gets the same type of weather. So once you get into the spring, it feels really good. You start to see activity rebound, and sometimes it rebounds very, very aggressively. Then you get into mid-cycle, the economy's still growing, but eventually you get to a peak point, and you could say we're really past peak across the entire globe. But as I mentioned, even though we're decelerating, the rate of change is slowing, that does not mean we're turning negative here. China's seen better days, although I suspect China could actually get into more of an early cycle environment throughout this year as they recover from their COVID shutdown. Certainly that should allow people to get out there and spend money and live their lives, just like we did here about a year ago. But nonetheless, the US economy does continue to expand. And that's really, really important, because as long as we get this economy to continue to expand, we do believe the overall fundamentals of the market should be a lot better than people realize. Now, I'm going to be bold here. Today, in May of 2022, we believe the recession probability is close to 0. That's the red line. You can see what that looks like. And we spent a lot of time with advisors on this, right? Certainly I'm sharing it with you, but this couldn't be more of a contrast to what the nightly news or the social media continues to say. So, to say we're optimistic and constructive, as I mentioned, would be a true statement, because we still remain that way. And then one last point here on the economy as it evolves is the very fact that these green bars, which represent equity returns, are still positive. But I want to be fair. As you migrate into late cycle, you notice this green bar is not as high as the other two. What that basically tells me is that as you slow the economy down, the equity market's just not going to give you 20 to 30% returns, right? That should not be expected as we continue to see a very tight economy here. But notably, we're not in that recession phase where historically you have seen negative returns, right? So, again, just dispelling some of the myths that a recession is inevitable. Now, a few more observations here. Maybe I'll speak for another 7 minutes or so. The observations in the financial market, and you might have heard of this old adage before, but there is a very strong relationship between stock prices and the earnings that those companies actually generate. It makes a lot of sense, right? I mean, why do we buy equities in the first place? Why do we buy Apple stock? Why do we buy Tesla? You name the company. Why do we buy it? Well, in anticipation that that company is going to be profitable. And of course, let's not forget, it was easier when we actually had the stock certs, right? Back in the 90s, if we even did it in the 90s, but certainly there's no more stock certificates, right? It's all electronic. But when you had that stock cert, it actually said you had ownership, right? You could show up at the annual meeting and vote, right? On some proxy vote. But nobody does that anymore, right? We're just looking to make money here. But think about that ownership. If the company was going to be profitable, the stock price should reflect that. And that relationship still holds true today. And we know that earnings in the market precipitated throughout this pandemic, right? Significantly up 50%. That doesn't really happen. But now into 2022, we believe the earnings are still going to be constructive, right? Up 10%. I'd say that's debunking some myths here, right? And now, how do we get good earnings growth? Well, you get good earnings growth if you have a decent economy where people are employed, people are making this, right? Money, they're spending, they're consuming, revenues are up, margins are healthy, companies are profitable, stock prices will reflect that. That's as linear and as easy as it really is. And we do believe that relationship is intact. Now, as I say that, the earnings have held up here, but yet prices have declined. You know what I think of when I see this type of chart? This is looking at the price to earnings ratio. This is the valuation metric, right? Not to get too deep here, but it's a really basic concept, right? Prices relative to the earnings. Prices follow the earnings. The numerator, the P, should follow the denominator, the E, the earnings. And what you'll see here coming into 2022 is you have seen multiples compress. They have contracted. Now, again, at first glance, this would tell you that the market has sold off, even though the denominator has actually done really well here so far in 2022. But I would consider this a valuation reset, right? Sometimes to have a sustainable market of good returns, you need these intermittent pullbacks, because the last thing you'd want to see is some asset bubble, right, where the market implodes. And even though it feels like it this year, we actually don't believe that to be true. We just believe that the market is really resetting on the valuation, which tells us this would be an opportunity to buy. And let me also be very clear here, and Aaron, you know this, I am not talking about a payback between now and the end of this year, right? Because quite frankly, I don't really know, right? If I'm going to invest $100, $1,000, heck, $1 million, right? If we only had it, I'm not looking to make money in 6 months, right? I mean, certainly I might, but that's when it gets a little bit dicey. But if I'm looking for a 3, 5, heck, a 10, 20-year investment time horizon, yes, is this a good time to put some capital to work? Undoubtedly so, right? As long as you can sleep at night and be tolerant of the downside volatility when it presents itself. Now, a few more thoughts about why earnings have been good. We talked about the economy. A big component of this strong economy has been labor. People are back to work like we haven't seen ever, right, in our economy. And we also know, I'm not going to ask for a show of hands because I can't see y'all, but how many people have been to a local purveyor of goods or services just to see a help wanted sign there? How many people have been to your favorite restaurant or favorite bar, and yet the tables are half empty, but you got to wait almost an hour? Of course, right? Me, myself, and I, we've all done it. But that's because there are a tremendous amount of help wanted signs, tremendous amount of job openings. You don't see the economy contract historically when employers are looking for people at the rate they're looking for them. It just doesn't happen. I would almost call it the immaculate conception. If it were to happen, it would be a historically rare event. Not to say it can't, but yeah, not to go deep, not too deep there. A few other points. We know income is up. People are spending their money. And here's the ultimate punchline. In aggregate, that's the key word here, right? If I were to look at all United States citizens, when I look at the amount of money that they have in savings, it still sits at over $2 trillion, right? It's pretty amazing just how prolific the savings rate has been and just how much money people have. Also, look at the banks, right? The banks, if you look at bank deposits, I only look at this to say, well, our households in a good position, right? Prices are higher, gas prices certainly are higher, food prices are higher, the borrowing costs, right? Mortgage rates are higher. These are all challenging observations. But what about all the money that households have in aggregate? And I say that because there's always examples where people don't, they can't make ends meet. But in aggregate, things are a lot better than you might be feeling. $16.7 trillion. These are huge numbers in terms of the amount of money in banks deposits, very different from where we were pre-pandemic. And then maybe just to round things out, we know this economy has been, again, kind of an interesting one with the pandemic, but let's be fair. People have been spending money on goods, not so much money on services, meaning people have been buying things on Amazon.com. They've been buying furniture, appliances, maybe an automobile, an iPad, but they haven't really been going out to restaurants, to the theater. They haven't been booking vacations, rock concerts, sporting events. And in some cases, a lot of that stuff was disallowed by your local government officials, right? Restaurants weren't open fully the past couple of years. Well, now we're starting to see that migration occur. People are spending less money at the retailers, right, to buy home decor, and they're spending money on that concert, right? In fact, they're splurging on some of these experiences. We call that the service economy. It's a feel-good economy. I'm a big fan. And I do believe that's going to allow this inflation topic, which has been the topic of the year, to really pause and start to abate. And as that happens, I believe this economy will continue to expand. And as that happens, I believe this market is going to regain its footing, and you are going to see an upside surprise here. May not happen throughout the duration of 22, certainly, but over the next year, year and a half, I do suspect if you stay the course, if you continue to employ patience and discipline as an equity investor, getting back to that value proposition, if you're willing to assume the downside risk, you can achieve this average annualized return of 8%. And maybe the last point I'll make here, Aaron, and you know this very clearly, this 8% return is the average in the market, right? There's obviously sectors of the market, there's industries of the market, there's companies of the market that could do a lot better and others could do a lot worse. And obviously with the assistance of the team that you're working with, I would say your compass point is going to be very, very bright and viable. So I'll stop there, Aaron. I don't know if we're taking questions before we transition over, but happy to do so.
No, well, so Mark, if we have any questions directly for Brad, let me know and we'll get them in there. But just want to say thank you for the insights. Thank you for your help. Thank you for fitting us into a very tight scheduling window as well. We do appreciate it. So I am not hearing any questions, and so you are free to go. Thank you very much for joining us.
Thank you so much. Thanks for your attention, everybody. Enjoy the rest of your evening.
Thank you. All right, so that was a little bit about the equity market, which has gotten a lot of the headlines and shown up a lot of big numbers over the past few weeks and months, up 400, down 1,000, up 700. It's been all over the place. But I think you could make an argument that the fixed income market has actually been even more volatile on a pound for pound basis. And so there's a lot to digest and think about there when it comes to bonds and what is traditionally supposed to be the boring, stable component of your portfolio. So joining us today from T. Rowe Price is Franco Dietry. He is an investment specialist with them who covers fixed income. He has a degree from Philadelphia University. He's got an MBA in finance and investment management from Yale. And I am also pleased to note we do have an all CFA panel here this evening, Franco, Brad, and myself. So Franco, why don't you take it away and tell us a little bit about what's going on with bonds right now. Thank you.
Aaron, thank you for having me on. Enjoy listening to Brad coming from Fidelity with some equities. But now let's talk fixed income. I know a lot of the questions are around why has performance been so challenged this year. Usually when equities sell off, bonds tend to be your ballast. They hold in, they perform well. They really haven't this year, and you can see that probably by looking at your statements. What has caused that downturn in fixed income? It's really the lack of direct communication, which we call forward guidance, coming from the Federal Reserve. They said to us, they provided their goals. They wanted to have maximum employment, and we all know that they've hit that. We've seen the unemployment rate at 3.6%. We expect that to start increasing, except before that happens, probably this Friday, it may trickle down to 3.5%. And then price stability. We've heard Brad talk about inflation. Inflation is really what has been causing the Fed not to provide forward guidance. So all the volatility that you've seen this year is pretty much the market repricing what the Fed is going to do. The Fed has been very, very clear in what they have said. They said they are willing to risk a recession. That's why recession talk is all over the news, to get inflation back in order. Very clearly, they can only control one side of that equation. They can only control the demand side. They cannot control the supply side. And we've certainly had some supply issues starting during COVID, starting with China and continuing. And then due to the unfortunate war at the current time in Ukraine, we're starting to see food prices globally increase. But the volatility, we at T. Rowe Price think we're probably about 3/4 of the way through. And why do we think we're at that point? We take a look at what the Federal Reserve has done. They've already hiked interest rates 2 times this year. We're now at about 1% on the federal funds rate. They're expected to increase the interest rate 2 more times over the next 2 months by 50 basis points, 50 basis points in June and 50 basis points in July. What we're waiting to see and what we are looking for is what move are they going to make in September? So in September, they can increase by 50 basis points or by 25 basis points. In the markets, we tend to price everything. Right now, that's a toss-up. It's a 50-50 split between 50 basis points and 25 basis points. At T. Rowe Price, our U.S. economist is thinking that the Fed will hike 50 basis points. The markets most likely will not respond favorably, whether in looking at equities or fixed income. If they hike by 25 basis points, we'll have a nice September to start the fall. We do expect the Fed to continue hiking in November and December to bring the federal funds rate back to about 2.75 to 3% by the end of the year. And that's how the Fed controls that demand side. We take a look at mortgage rates. They have increased significantly. I know they eased a bit last week, but they were over 5.3%. And that slowly trickles through the economy. We do agree with the comment from Fidelity. We are not concerned about recession this year. Typical recession probability, about 10%. As we get to the end of 2023 and we get into 2024, our recession probability increases to 30 to 40%. Because it takes a long time for these increases from the Fed in the interest rate to work their way through the system. The Fed also will intentionally cause the unemployment rate to go up. If we take a look at it, there's just too many open jobs for people. I know that doesn't sound great. It should sound really good, but it's not really good in terms for demand. With that, the main concern for the Fed about inflation, one question I had asked to me last week is, what is really the importance of inflation? The importance of inflation affects the end consumer, especially the lowest earners of society, because they're greatly impacted by those variable costs. But more importantly for the Fed, they're concerned about a wage price spiral. So if inflation is continuing to run very, very hot, employees will continue to ask for higher raises. That will in turn cause prices to increase as you're supposed to cover your costs. That is what happened here in the 70s and early 80s. There was a wage price spiral. People went out and purchased goods because they thought they were going to be more expensive in the future. That doesn't happen here today in the US. It actually does happen in Japan in today's environment, but not here in the US. So we at T. Rowe Price think the Fed will continue to hike this year. We get towards that neutral rate. That neutral rate, really hard to come upon. Jerome Powell, chairman of the Fed, gave you a range, 2 to 3%. We're going to get closer to that 3%, and that should be neither accommodative or restrictive for the economy. They're trying to find that sweet spot. It is tough to have a soft landing, but it is possible. You heard there is a significant savings, about $2 trillion. And take a look at employment. Employment is still quite strong. And even if it does increase to, say, a 5% unemployment rate, that is still very strong historically. So let me summarize our thoughts. We think that the Federal Reserve has been driving the volatility. They changed their policy 2 years ago to state that they weren't going to hike interest rates until they saw inflation. And guess what? They see it, and it's hot, and it's heavy. If we look at market forecasts, we have all been wrong forecasting inflation the last 2 years. We thought once the economy opened back up, we would stop buying goods, move back to services such as going out to eat, traveling, even doing simple medical services such as seeing the dentist, which many people do not like to see. That hasn't happened. It's taking a little bit longer than expected, but we're slowly starting to see it. Inflation, very high. We saw the last inflation print, 8.3%. At T. Rowe Price, we think we get down to 4.5% to 5% as goods inflation comes down and services, your rental expense, your owner's equivalent rent, and food prices kind of come up and stick around a bit longer. As I said, we expect the vast majority of volatility to be somewhat complete. September for us is a pivotal moment to see what the Fed will actually do. So what do you do in terms of fixed income? We know it's a very short time period. In the last 3 weeks, fixed income is actually working the way it should. As equity sold off, fixed income has rallied, has started to generate those returns. We think that we're moving into that phase where we're going to get a bit more normalcy in the markets. The 10-year US Treasury yield has stayed below 3%. I know it surpassed 3% twice in this. Nope, we're still in May. We're not in June, so twice in this month at the very beginning. However, we think that there is support at that level, and we're starting to see more normal parts of the market. So how are we positioned? What do we like? We like the front end of the curve. We're shorter duration at the current time. When you look at fixed income, really serves two purposes. One is a ballast versus equities, and those shorter duration, high quality fixed income still serves that purpose. They're down this year, but they're down slightly, down 1% to 2% gross, depending on which type of strategy you're looking at. But then the other purpose of fixed income is to generate income. And where are we finding that? We're finding that in the higher yielding parts of the market in floating rate loans. Floating rate loan, the name kind of explains it. These are lower quality companies, inexperienced with the capital markets. They need to get loans from banks, and they're floating rates. So as the Fed raises rates, it takes time to work through, but eventually the interest you receive is higher. That's why they're called floating rate notes. And lastly, what is one of the most durable asset classes? Just looking at sector performance, your standard benchmark, we're looking at high yield municipal bonds, a mix of high yield with investment grade, higher quality. If you go back to the last 15 years, there's one sector in fixed income that shows up in performance, top 5 every other year, and that's tax-free high yield municipal bonds. So to bring it all back home before we pass it to Aaron, and we'll happily take any questions, the Fed is driving the volatility. We think we're 3/4 of the way through. No concern about recession this year. It increases significantly more at the end of 2023 and into 2024. And then finally, what drives fixed income returns? Two components. One, you buy a bond. We buy a bond at par, let's call it 100. You sell it for more or less. We call that the price return. The other one is the income component, clipping that coupon you get typically every 6 months. That coupon has started to increase. Fixed income is much more interesting at the current time. And historically, taking a look at benchmarks, taking a look at US government bonds, over the last 15 years, 85% of your return has come from the income component. Once you move further away from government bonds to US high yield, municipal bonds, those front end strategies that we currently like at this time, your floating rate, over 100% of your return comes from the income component. So when looking at fixed income, this year has certainly been challenged. Take a look at your returns over the 2-year, 3-year period. They still should be positive. Fixed income, hold it for the medium term. Let a manager do what they said they should be doing. They stick to their philosophy and process, and let income do the rest. And I'll stop there and pass it back to Aaron.
All right, thank you very much. I will say, speaking personally, we expect more normality in the markets is my favorite thing I've heard anybody say in a couple of weeks now. So thank you for that. That would be nice. So there you've heard from both the fixed income and equity sides of the debate. I'm going to take a couple minutes and talk a little bit about where we at Signature see things and sort of how we synthesize all of that together. But I think the messages that you've heard here are fairly consistent, which is that it has been a wild ride to get here, but that we are sort of most of the way through that wild ride, either in equities or in fixed income. And I actually have a couple of charts that I wanted to hit and show real quick that I think illustrate what I would say are probably the two key takeaways that I think people should have from this call or from this moment in time in the market. So let me go ahead and start this and share this. So this first chart I am going to show you is just a very simple chart of Amazon's stock price for the last couple of years. And I have Amazon here because I think Amazon in a lot of ways at this moment in time is actually a pretty good proxy for the broader markets. It's a retail stock with Amazon. It's a tech stock with their cloud business. It's a media stock with Prime Video. It's a lot of things to a lot of people. They're even trying to get into credit cards and finance a little bit. So I think in a lot of ways, Amazon is representative of this moment in time in the market. And what is clear to me on this chart is that there's a very simple message to take away from what the market has been doing lately. And that is, we have given back the COVID bump. This is COVID right here, right? This is March of 2020. And you can see Amazon was chugging along, but it had hit kind of a ceiling right around $2,000, $2,100 a share. Tried to break through that level a couple of times, just finally got over the top, and then COVID comes along and ruins everything, right? But then this is what we see happen through the end of COVID, as we all sort of realized that it wasn't the zombie apocalypse. We were eventually going to be able to get out of our houses and have vaccines and all the rest. Market took off, and we had a big old bump, and then we gave it all back, and lo and behold, we are right back where we started. And what this chart does is it illustrates a couple of key things. Number one, it's a clear as day representation of the concepts of support and resistance, which is a kind of technical analysis. I'm not going to teach my class right now and go into details, but oftentimes we see ceilings that become floors when we look at charts in the market. And that appears to be what is happening here as far as the prices are concerned. This was a ceiling. It has now become a floor as we bounced. But the other thing it does is it shows that what happened here is we gave back the COVID bump. And I think it's fair to make the argument that the COVID bump was never really all that real in the first place. It was a sugar rush brought on by stimulus and cheap low rates and the exaltation of the fact that it wasn't the zombie apocalypse. And we all did get to go back outside again for a while there. And so we had this froth and this bubble in the market. And then 2 years later, we gave it all back. But if the worst that happened is that we gave back the sugar rush, that's not really damaging to the long-term trend of the stock in any way. We just gave back the little sugar rush. And I think that's a good way to look at what's happened in the broader market. Last summer was a lot of fun. Crypto was crazy. Monkey JPEGs were selling for millions. It was a big party, but it was a sugar high. And now we've come off the sugar high. And now the market's a little bit hungover and it kind of feels like it doesn't want to get out of bed right now. But doesn't mean that we've damaged the long-term trend. And it doesn't mean that we can't go right back the way we were. And I think that's an important way to look at the overall idea of why did we have this pullback? Why is this going on right now? You can say Ukraine and you can say inflation, and those are all causes and approximate important causes. But the reality is we had a sugar rush and it has worn off. And I think that's what we're seeing in a lot of charts. It doesn't mean, however, that Amazon is in a meaningfully worse position than it was before COVID started. It probably isn't, right? It's certainly they've added a lot of customers. Yes, they have some labor issues and some other stuff going on, but are they meaningfully worse off than they were 2 years ago? And, on this, when we had this call last month, I used Zoom as an example. Zoom is very clearly a company that's probably not meaningfully worse off than they were before COVID. And yet the stock prices are back down at those levels. And so you have to ask yourself, is that just a representative of the bubble going away, or is that something longer term? And I'm not sure that it is. So that was one chart that I thought was interesting. The other chart I'll share is this one. And this is from the same place I got last time's chart. You can follow him on Twitter. His name's right down there. Great follow if you want a lot of really interesting charts or different ways of looking at the market. As you may know, we just had one of the longest consecutive down week streaks ever in the history of the market. We went 7 weeks in a row with the S&P down for the week. That's only happened twice. There's been, you can see 2 8s, bunch of 6s, right? So this is all of those historical lengthy declines in the S&P on a chart. And you can see we got a pretty good mix. We got the Great Depression, we got the Great Recession, we got some inflation and whatnot in the 70s, we got the tech bubble bursting. There's all kinds of good examples in here of how much we were down, and we were down pretty big. We're up near the top in terms of the size of the decline and the length of the decline. But what I want to show you is what are the forward returns from that point? Where was the market 3 months, 6 months, etc., from when these occurred? And you can see even at the 3 month part, more positives than negatives on here, and really only 2 outcomes where it was meaningfully negative, and that's the Great Depression and that's the Great Recession. Those were the only 2 times where it got really, really worse from this point, right? And you can see going forward, again, with the exception of the recession and the Great Depression, and the tech bubble bursting wasn't great either, most of them are pretty positive or moderately down out to a year. And by year 3, year 5, year 10, you're almost all positive, right? 2004 is a fun one, right? Because it lasted 6 weeks, but it was barely a drop. Then it came back and everything was fine. And then it ran smack into the Great Recession here in 2008 and pops up this one little negative right here, and yet still managed to finish with a very respectable 10-year number. And when you come out here and you look at these 10-year numbers, a couple of them aren't great, but for the most part, we'd all be pretty happy with those returns over an extended period of time. And so the other very important takeaway that I want you to have from this call is that there are no important takeaways from this call, because 3 years from now, you are not even going to remember that this call happened. Okay. So as much as I want to say, in the moment we do these calls because it's important to talk about these things, in the long run, this is not going to rank on anybody's most important Zoom calls they've ever been on. I can promise you that. So those are two charts that I wanted to share that I think kind of do a little bit to highlight how we at Signature are thinking about things. We're not looking at this with a 3-month, 6-month, 9-month, 1-year time horizon. As our clients, we know that all of you have timelines that are at least in the decades. Some of you have timelines that are in the centuries, because there's generational wealth to be discussed here. And so it is important to not let 6 months or 3 months or 1 year cause you to make large or meaningful investment decisions, because you may very well be reacting towards the end of this slide and things may get better. If you ask me personally where I see the markets going for the rest of the year, I think we're a little bit hungover right now. And I think that's going to persist through the summer. And I think you're going to see a lot of chop and a lot of bouncing around. And I think we're going to end up at exactly the same point we are right now. It's going to go up 500, it's going to go down 400, it's going to go up 200, it's going to go down 300, but we're going to end up right back where we started. That probably persists through the summer, which is a time of volatility and not really huge movements in the market on a seasonal basis anyway. And then, as both of our speakers said, heading into the fall, there's actually a lot of positive news. There could be a lot of tailwinds coming into the fall if we can get a resolution in Ukraine, if China is able to open up, if we find that COVID variants are slowing down and not causing big problems again, and corporate earnings, as Fed, continue to be strong, and the Fed continues to do what we expect them to do, then there is an opportunity for things to look better in the fall, I think. And so right now, what I have been saying to clients and what we genuinely believe is that the most important thing right now is to sort of not overreact in either direction, to not load up and get bullish because you think everything's going to be great, because it might not be, right? It's been a long time since we had a real recession, and typically we don't go 13 years without having a real meaningful, lengthy sort of down period in the market. So it's been a long time. We are kind of due, but also all of the actual symbols and signals that we just talked about with both of our speakers today, most of them are flashing relatively positive signs. So there doesn't appear like a recession is likely, but one is possible. And so we try to thread that middle course, keep you properly allocated, keep you properly diversified, put you in a position to take advantage if markets rally, and also not to take real mortal damage if markets fall, but to not overreact in either direction and say, yep, now's the time to go all in, or now's the time to take all the chips off the table and shove the cash in the mattress. That's how you get hurt in environments like this, by overreacting. And so we think the measured course is the right course right now. So with that in mind, we do have a little bit of time here at the end for questions. I know we have at least one. If there's anything else that you do want to ask or you do want us to talk about a little bit, please feel free, type it in the chat. Again, send it either to Mark or Julia. And Mark is going to start lobbing questions at me, and we'll see what I can do here.
Yeah, we do have a bunch, Aaron. And,
okay, good.
We have about 10 questions that came in specifically on fuel prices.
Sure.
As we watch fuel prices continue to increase, specifically, what effect do you think they will have on the economy, either continuing to struggle or not being as much of a concern over the long term? And how long can we continue to sustain this?
Sure. So fuel prices, certainly elevated fuel prices, are certainly a drag on the economy. Not a huge drag, but a meaningful one that you would notice. But they also tend to typically be a fairly short-term drag, because the profit incentive when oil prices get high eventually becomes to pump more oil. Most of the producers right now are holding back on pumping more oil because they're enjoying the high prices for the oil that they have. But there is, to be fair, a lot of spare and excess capacity in the world, even if we do shun Russia, certainly here in the United States, to produce fuel and oil as needed. So if you remember, in the recession, 2008, 2009, oil prices got all the way up to about $140 a barrel. Right, we're pushing close to 125 right now, and that is definitely elevated, well above the historical long-run average, which is around $80 a barrel. But those spikes, they tend to be fairly short-lived. They last 3 months, 6 months, and then they tail off because eventually other producers will come in and put more supply in to take advantage of those prices. So they do act as a drag, but they're not one, excuse me, that we see persisting for too long. The summer is going to be interesting, especially in southern states, places like Texas, where the air conditioners are going to be fired up and a lot of energy is going to be consumed through the summer months. We could see a repeat of some of what we saw happen with the Texas power grid last summer, where they had some problems. Those kinds of issues are likely to happen over the course of the summer. But I would be surprised if we're still dealing with this level of elevated fuel prices in the fall. And if we are, there are a lot of things that could be done to address it at that time. I think those things are probably going to happen naturally, though. So they're a concern, but only if they persist for an extended period of time. If we can get through the summer and get back to a relatively more normal day at the pump, where it's, in a number that starts with a 2 or a 3 instead of a 4 or a 5, then that's something that that I think can be actually a positive for the economy into the back half of the year.
We have several questions, and we may want to throw this over to Franco if he's still available. But a few questions on whether or not the Fed is doing enough as they are raising rates. Should they be doing more? Should they be doing less? Are they getting it right? And what do we expect? How long do we expect them to continue raising rates for? So I know you touched on this a little bit, Franco, but if you could just summarize again.
What is T. Rowe's official position on, are they behind the curve?
Well, they've actually said it themselves. They are behind the curve, right? They make decisions real time, and they have to do that. If you look at what the Fed did during COVID, they in essence prevented a long recession. Take a look at what happened in 2008 versus the difference in 2020. Maybe they should not have been buying bonds earlier this year. Perhaps they should have ended that last year. They also had to deal with the American Rescue Plan, which perhaps could have driven some of that inflation. So is the Fed doing enough? We think they're doing enough today. They have in essence said they will do anything they need to do to get inflation in order while risking a recession. So for us, that is about as hawkish as you could get from the Fed. These 50 basis point hikes, we do think make sense. We do think it makes sense to front load it. So they started with 25 basis points at the beginning of this year in March. They said they would have done 50 if the war in Ukraine did not start. So that held a little bit of reserve from the committee, and they will continue with 50. So are they behind the curve? Yes, they are trying to catch up. Is it possible to have a soft landing? Yes, but it's a very small possibility. Should there be a recession? We think it would be a growth recession, maybe just 2 quarters of negative growth from all the positive things that you did here. Not only are consumer balance sheets quite strong, state and local balance sheets are strong, and corporate balance sheets are quite strong. So we do think the Fed is a bit behind the curve, but they're doing all they can to catch up. And I know we've heard this before, but it was unprecedented to have a pandemic in which consumers had more savings than they did prior to the recession. That hasn't happened before because of the government transfers.
And the other thing that I'll add is that behind the curve or not, which I think is a fair question, and there's good answers on both sides. I think when you look internationally, the US is actually doing a little bit better than most of the other countries in the world. We're at 8-9% inflation in the US, but you look internationally, there's a lot of 10, 12, 15 out there. And if you look at rates in the US are already higher than they are in a lot of parts in the world. And we're continuing to aggressively raise, where in some countries, they're not even raising at all. And so when you look at that balance of, sure, inflation is high, but it's not as high as it is elsewhere. And rates are maybe not as high as we would like them to be, or we're not as forward as we would have liked, but they're still doing better than we are seeing elsewhere in the world, which I think makes an argument that, are we behind the curve? Yes, but to Franco's point, it's a pretty weird curve to have been dealing with, and they're trying to do the best they can. And also, I think we're still better off than a lot of other places in the world. Even if we are behind, I think many people may be even further behind us. So it's going to be very interesting to see in Europe, for example, how they deal with this, where obviously they're a lot closer to the war. Their energy situation is a lot more chaotic than ours because of the relationship with Russia. And they are at negative rates in a lot of countries, and certainly very low for the Eurozone period. So I think that it's going to be interesting to see how this plays out around the world. It's going to be interesting to see how they do it here in the US. What I have always found important is that the Fed be as transparent as possible. To Franco's also earlier point, that we kind of know what's going to happen. We can argue about whether we think it's a good idea or not, but I prefer to not get surprised is really the most important thing to me there. And that is one thing I think the Fed has been pretty responsible about doing. You may not like their choices, but they've been pretty loud and open about what those choices have been and what they're going to be.
And I think to follow up with Franco while we still have him, we've had a bull market in bonds with declining interest rates for such a long time. I mean, I don't know how long it's been, but it feels like, years and years. And so, are we going to, should we expect that when we look at overall the total bond market, not just high yield or floating rate, but when we look at the total bond market, should we expect that we're going into a long-term bear market for bonds and that bonds will not offer the protection that we've become accustomed to?
So when you take a look at it, it's been a 40-year bull market in fixed income, right? Starting back in the early 80s. Taking a look at the overall fixed income markets, I know we mentioned this earlier, but we're getting back to normalization. Taking a look at the 10-year US Treasury yield approaching 3%, big difference from where we started the year, 1.5%. But in 2018, 2019, we were at 3%. If you go back to 2005, look at the average, we're about 2.8, 2.9. So we're starting to get yields back to a more normal state. We do think that stock bond correlation, stocks going down, bonds giving you that balance, it is starting to come back. We do expect to see that. Think about what the Federal Reserve has done. During COVID, they bought a significant amount of treasuries and mortgage-backed securities. They suppressed what we call the term premium. So that additional compensation that you get by buying a 10-year US note versus a 1-year US note or a 2-year US note, that turned negative. We're starting to see that premium come back into the market. So we do expect higher yields across the board. If you talk to anyone, even outside of T. Rowe Price, we still expect yields to increase in investment grade and high yield as they normalize. They have been compressed. The Fed did something that we now as investors will expect that every time when there's a certain extenuating circumstance will happen. They bought a very, very small amount of US high yield ETFs and US investment grade bonds. I'm talking less than 15 billion. That is not a lot in the global fixed income market, the US fixed income market, which is just in treasuries is 23 trillion, excuse me. We now expect that to happen, but those yields are going to go up. Are we in a bear market? Tough to call. We don't think so. We think those yields are starting to normalize, and it will give Fed the opportunity to cut rates should that recession come back.
Okay, thank you. So Aaron, I've got a number of questions here, and again, you did address it when you talked about staying with the proper portfolio allocation. But people want to know what exactly, based on everything we just heard from our speakers, what exactly should we be doing over the next several months if the market's going to continue to be volatile through the summer, if we're not likely to see a raging bull market tomorrow, or hopefully not a terrible recession or a continued decline in the market that drops another 20%. What should we be doing within the portfolios? What are we doing?
Sure. We've actually heard a lot of that already, but let me put it together. Let me start, of course, with the standard caveat that I make whenever I talk about this stuff. I'm going to talk generally about how we're structuring client portfolios across the firm, but it's always important to note that everybody's situation is different. And when I say things about we're doing this and we're doing that, doesn't necessarily mean we're doing it in your account personally, but directionally and in terms of some of the things that we've heard talked about. Franco mentioned floating rate. That's definitely something we have been adding to the portfolios for those clients who didn't already have it. Again, those are bonds that will do well in a rising rate environment, certainly where we are. Again, also, as Franco noted, we're trying to get down to the shorter end of the curve, looking for bonds under 5 years rather than 5, 10, 30 years, and so on and so forth. And that's in the fixed income component. In the equity component, I would point to something that Brad said, which is valuation reset. Right? That's another much shorter, actually simpler way of my whole spiel about giving back the COVID high, right? We've reset the valuations. Valuations got a little high and crazy. Now we've all come back to a more normal, regular multiple. So we're looking at places where those valuations have reset and where there are opportunities to get into some of these companies. Now actually is a fairly decent time to buy Amazon because it's been brought back down to that, what used to be a ceiling, which is now a floor If that is true and we're close to the floor, that's a buying opportunity. So we're looking for companies like that, good, strong companies that aren't going anywhere, that are now 10, 20% off. We're looking at things like that. We're looking obviously at the energy sector with oil prices this high, with energy demand increasing, and that's even with shutdowns in China. There's going to be another big bump in energy use when they come fully back online as well. We expect to see a big bump over the summer. So that's a market that we feel like that's one where we're maybe still in the early stages of a longer term rally, and where we can buy things that are still going to be going up a year, 2, 3 years from now. So there are a lot of different things we're looking at. This also feels like sort of a turning point or an inflection point in the market where things that used to work stop working, and it's time for a new set of companies to come forward, right? You look at the stocks that did well under COVID, the Zooms and the Netflixes and the Pelotons and even the Amazons. Feels like that story's over. Feels like it's time where the market now is looking for some new stories and what's going to be the next generation of leaders over the next few years of the market. And so we're trying to look at sectors and themes that we think are going to play out there. And that includes electrification of vehicles, right? A lot of companies are coming out with their new electric cars. The new F-150 is selling like hotcakes. It's not just Tesla in that space anymore, right? Tesla obviously dominates the headlines and it's all Elon Musk all the time, but there's a lot going on in the EV space beyond that that we think is very exciting. And we think there are a lot of other opportunities, even in just some old boring, basic things like Amazon, or like some opportunities in blue chip stocks. Financials typically tend to do well in a volatile market like this. The big traders, the Goldman Sachs of the world, tend to do quite well in market environments like this. So I always hate quoting Jim Cramer, but the one thing he says that's true is there is always a bull market somewhere. So there are opportunities to go out and look for things that are the right thing to do for right now. But the right thing to do in general is obviously not to overload too much in any direction. So all the things I'm talking about are tweaks that we make around the edges. The broad core of a well-diversified, well-managed portfolio is still going to stay the same. It's going to be equities, it's going to be fixed income, it's going to be some real estate and commodities and some alternatives to provide some diversification and some keel. And good diversification never goes out of style.
Okay. So I think that's actually the end of the questions. I think I've summarized most of them. I will tell you that we got a number of comments that people are not buying that we're not going into a recession. And I do want to say that I understand it feels that way. And the recession, a recession is an economic term more than a market term. And we certainly touched into a bear market prior to the rebound last week. So whether you feel like it's a recession or it actually turns into a recession, we understand that. We're watching your portfolios closely, but we're also talking to all of you and understanding that there's fear. We are getting a little bit more optimistic. I think you heard a lot of that today, and hopefully we can take advantage of this downturn. We had to go through it, so we may as well try and take advantage of it where possible. And for most people, we gave back. Aaron showed that Amazon chart. We gave back some gains that we had during COVID, and for most people, we were okay before COVID happened. Your portfolios were okay, and we were on track to reach our goals. And so if we're back to that point, we're back on track still, or we're still on track, I should say. No one wants to see a decline, of course, but we all know it's going to happen. And I forget if it was Franco or not, but somebody said that the recession happens every 6 years, or a recession happens every 6 years. We haven't seen one in a long time, but we know as experienced investors that every year is not going to be up, and we are going to see this again, probably several more times in all of our lives. So it's just making sure that we're allocated properly and that you have a team that is looking out for you and truly cares, and we are here. So if you've got questions, if you are concerned, or if you just want to talk about it, or if you want to talk about some opportunities that it might present, make sure to reach out to us, and we will definitely walk you through that and make sure that you're still on track to reach all of your goals.
Let me just add real quick that I get that, and I share that vibe. It has felt a little bit ominous for the past few weeks, so I certainly understand where that feeling comes from. What I always try to remember, though, is that when things are bad, it's very easy to project them continuing to be bad. And when things are good, it is very easy to project them continuing to be good. And so one of the things that I try to do and am intentionally trying to do is make sure that you do look at both sides of it. And then when things do feel ominous, you are out there checking and saying, well, okay, do the numbers support this feeling? And for the most part, this is a situation where they kind of don't. And so I think it's important to say, I feel that way too, but I look at the data and the data tells me a slightly different story than my feelings are telling me. And the thing about the market is that the market is about 50% data and it's about 50% feelings. So feelings are important and they do play a role, but data is important and it plays a role too. And then when data and feelings are in conflict, as Warren Buffett famously said, be greedy when others are fearful, be fearful when others are greedy. You're probably going to come out ahead in the long run doing that. So I'm going to use that as an opportunity to wrap up. I want to make sure very, very much that I thank two fantastic partners, Fidelity and T. Rowe. They don't just provide helpful speakers, they do a lot of great stuff. I said before that I can't make statements that apply to everybody's portfolio, but I can say every single person on this call has at least one product from each of those companies in their portfolio. So thank you very much to Franco, to Brad, who is no longer here, but I think somebody from Fidelity might be. So thank you both to them. Thank you all to clients for coming out and joining us on these calls. I'm always have tension about whether we should do these because it's very important to communicate, but I kind of meant what I said. 2 years from now, you're not going to remember this. So it's always a question, should we do it or not? And the answer is we always should do it. And I know that it's the right thing to do when I see all the people who come in and who listen. So even if you agree with us, even if you're not buying all the optimism on this call, thank you for coming out, for listening. An engaged client is a great client, and we're happy to see all of you here. And again, as Mark said, if you want to talk about any of this, reach out to me, reach out to your advisor. We are very happy to talk about this. Education and communication is just as important as investing and trading. And that's a big part of what we do as well. So we love to hear from you. And thank you all very, very much for giving us some time. Go outside. It's a beautiful day. Thank you.